All right, let's talk about what's really going on in the US markets right now. Stocks are bouncing all over the place. Bonds are screaming a warning, and the US dollar has been doing its own thing too. The S&P 500 has been volatile. Gold is quietly surging, and the 10-year yield is making some serious moves. So, what does it all mean for investors and traders like us? Let's break it down simply. Before we jump in, quick disclaimer, I'm not a financial advisor. This video is for educational and entertainment purposes only. Please do your own research before making any investing or trading decisions. So let's start with the S&P 500. Essentially, this is a basket of 500 companies that are publicly listed in the US and that come from different sectors: technology, communications, real estate. So what happens is the market is usually, investors are usually forward looking. In other words, they bet and put an expectation to say, is the market going to go up or down within the next 5 months or whatever period. Stock market is not the entire market. There are a whole other sectors, and that's beyond the scope of this video. So specifically talking about the S&P 500, one day it looks like we are breaking out. The next day there's a sell-off. This tells us something. The market is unsure. Why? There are mixed economic signals: inflation data, Fed policy, earnings, and global uncertainty. And let me show you on the chart in terms of the trading ranges for the S&P 500 this week. What on this chart is called, this is the S&P 500, and this is, I'm going to put it to a weekly time frame. You can see that this is a time frame for 5 minutes. Let me just put 1 hour, 45 minutes, or let's just put the 15 minutes. That's fine. But the idea is that if I look at a 5-minute time frame, this candle that you see here, they tell you what happens within 5 minutes. If you put 45 minutes, it means it tells you how the high and the low of that price in that particular time. In other words, it actually came down by 4.4%, if you can see, to this level. But however, it has recovered such that you can see that if we take the high, or we can just start at this level and look at where the price closed at, you can see that it went up by, let's say, about 1% from the low price that it went to. So if you look at it, this was the recovery, as you can see here. But what I was just trying to share with you, people make money by making the right calls. If you were bullish on this and you took a call option, or you just bought the shares and you got out at this point, you could have made money because you then make money on the spread. But you, in this case, would do that buying maybe S&P 500 ETFs that track the S&P 500, like SPY or any other instrument that tracks the S&P 500, because the S&P 500 index. What does this mean for investors? This is why I love options in this kind of environment, because it's very volatile, and this volatility can create opportunities. So I've been especially using cash secured puts and covered calls. They allow me to generate income even if the market moves sideways and pulls back slightly. And I've done videos to show my trading portfolio that I'm sharing with you publicly. Now, the bond market is screaming and communicating something. And the message from the 10-year yield in particular is very important. So the US 10-year treasury yield is usually set by the market, and the market usually is forward-looking. If it's very volatile and unstable, then it can create problems, because usually investors who might be invested in the stock market, they want the stability in the bond market, such that if the stock market becomes very risky, they can go to the bond market in that case, as has been shown by research over the past couple of years. It becomes very difficult. So that's why it has been very challenging. But if you look at the 10-year treasury yield, it has been hovering between 4.3% to 4.6% range, and that's high compared to the most recent history. when bond yields rise, it generally means that the market expects inflation to stick around or the Fed to keep interest rates long. What you see here is the US 10-year Treasury bonds, and you can see that here, that's the range, the trading range they've been trading at this point. But there was a point when it went up, and you can see here that even today it was very volatile. So let's look at the 5-day period. You can see that it has been very volatile, and usually it's supposed to be predictable. So if we take a longer term view of things, you can see that it has been predictable, right? And usually it goes in reaction to what's happening in the stock market. Most people, they talk about the stock market, but seasoned traders, they also trade bonds and currencies. You can see that at this point, it has been very volatile, and at this point it went to this level, and this is what has been driving some volatility. And quickly, you can also see what has been going on the currency market. If you look at, there's been the volatility, and this is the US dollar and also the euro, but the euro is the primary currency here. So it means the US here has gained a bit, but you can see that at some point it was plummeting. So in terms of the bonds, the 10-year yield increases the cost of borrowing, which can also weigh down on stocks, especially the tech and growth names. But it also means investors can get a decent return with less risk. So money shifts away from risk assets. And what this means is that a lot of people in this case, because of what has been happening, there's been sell-off and deleveraging. Some big funds and even investors and traders, they use leverage. So as the market drops, and if it goes against your trade, you can probably get a margin call, and usually they sell at the bottom, and it can accelerate the downward movement of the market. And that can be something that can cause issues. That's why I always want to use my cash. And like I indicated below on the chart, the US dollar versus the euro. But why the US economy, even though despite the tariffs and the uncertainty, it has been showing signs of resilience compared to Europe, and the higher US interest rates also attract foreign capital. So in simplified perspective, when the US dollar is strong, US exports become more expensive. That's bad for multinational companies. If you are looking at businesses such as Apple, Tesla, that sell or do business outside of the US, that's not really good for them. And you can possibly lose money from the currency fluctuation as well. It also tightens financial conditions globally, which in turn can hurt other markets and risk assets. And this is because the US is the global currency that most economic deals and partnerships happening. So that's the common denominator, the base currency. So what happens is the US can actually just make money. In economics, we call it seigniorage, by just printing money. And let's say the demand increases and they print more money. That means from that they get a premium. Now, traditionally, gold has been a silent hedge. What do I mean by this? Here is something that is very interesting to me. At the time of filming, gold was up 9.76% this month, according to the goldprice.org. That's massive, right? Why this matters? It is because gold is traditionally a hedge against uncertainty. Money is basically leaving the stock market and going to gold. And it's a hedge against inflation and currency risk as well. So when you see both equities and bonds wobbling and gold running amok what is happening, that's a sign that investors are looking for safety. I'm keeping an eye on it and holding some cash too. Being cautious is part of my strategy in this business. And let's talk a little bit more about my strategy that I've been using in detail. I've been using mostly cash secured puts and covered calls, and I'm using options to ride out this market. And here is why. Cash secured puts, I sell puts on stocks I want to own at lower prices. If I get assigned, I'm happy to own them at a discount and then start to sell covered calls. In that, I will own the shares right? And then I sell calls to generate income weekly, monthly. So that's what has been happening. In classic case, I've been doing a lot on SOFI stock. So this way I profit even when the market moves sideways. One trade I'm watching closely also I've been focusing on a few Canadian stocks like Aricia. I saw the cash secured put at a strike price of $42, but I ended up closing it and I made $40. The company has strong fundamentals, and I was looking at it, they actually had no debt in the recent years. And that's something that I'm looking at, despite that 35% of their supply chain is dependent on the Chinese market. So that's another risk, but it's a Canadian company that assembles and manufactures clothes, and people will have to wear clothes, right? So over the long term, I'm bullish on this, but I haven't opened a position yet. I'm waiting for it to retrace, but in the meantime, I'm using cash secured puts and options to make money from it. So here are the final thoughts and how I'm managing risk and staying sharp. So the bottom line is that the US markets are at the crossroads, in my view. Stocks are shaky, bonds are speaking loud, and the dollar is flexing. Volatility is here and it's not going to go away anytime soon. That's why I'm sticking to a plan to manage risk using options, to use high quality strategies like covered calls and cash secured puts, but also only doing it on stocks that are fundamentally strong, that do not have debt, that have great management, and that have really pulled down so that I have a margin of safety. And also, more importantly, keeping dry powder is something that I have seen that is very good for making money. In other words, stocks that are listed in the US stock market, Amazon, Google, and they had really dropped by some of them by 30, 40%. So that means that's a discount. If you understand valuation, and I've shared that if I look at companies such as Amazon, having 100 billion in cash and cash equivalent, it's a very strong business. So I'm looking at the long term, but things might be changing. So I'm playing safety, in other words, having a bit of cash, and I deployed a little bit, and I'm using options to have cash flows because cash is important for my day-to-day running. The other thing is that I'm watching the macro trends and gold quietly shining on the background, but now I don't think it's a good time to be getting in long on gold. So I'm just keeping cash. If the stock market then starts to rally up and gold and other stocks that are in that particular sector starts to drop, I have some stocks that I've been doing research on, and if they drop now as the equities market, the stock market goes up, then I might start to open some positions from my cash positions and money that I'm making from cash secured puts and other option strategies. So I'm not chasing home runs. That's the key thing. I'm compounding slowly and steadily. And honestly, that's how I plan to win in the long term. Until next time, trade and invest wisely and may the markets be on your side.